If you've got cash in a savings account, chances are you're earning less than 4%, while the banks are lending that same money out at 6 to 8%. In this episode, we show you how to become the bank and earn bond level yields safely with liquidity and control. Because let's be honest, most doctors and professionals we speak to have money parked in offsets or saving accounts, collecting dust and earning minimal interest. We want safety, liquidity, but also a decent return. But the moment we hear bonds, our brains check out.
For all the doctors and dentists, you guys own property. When you buy a commercial asset, you borrow money from the bank. That's a loan, a mortgage, and you pay the bank interest. Imagine being the bank. We're the lender. We receive the interest and we make a loan.
Today, I'm joined by Chris Joye, Chief Investment Officer of Coolabah Capital Investments, Australia's most active bond trader. His team trades up to $1 billion of bonds per day with over $15 billion under management.
The bond market is massive, trillions of dollars. In fact, globally, the bank bond market and corporate bond market is $30 trillion in size. And then if you include the government bond market, that's another $80 trillion. And that makes it very different to property.
In this episode, Chris Joye breaks down what a bond actually is in a way that anyone can understand. We dive into the truth behind bonds, hybrids, and how to safely beat cash returns with liquidity, and also why bond ETFs are finally becoming retail friendly. He'll also show you exactly where the yield is hiding right now without taking on the risks that we all want to avoid. Remember, everything discussed in this episode is general information only and should not be taken as financial advice. Hi everyone, welcome to another installment of the Investing for Doctors podcast. Today we have Chris Joye here with us, and he is the Chief Investment Officer of Coolabah Capital Investments. Welcome, Chris.
Thank you, B. I appreciate the opportunity to be here.
Before we start, we like to ask every sort of person that comes on the show, give us a little background about you, how you came to be the Chief Investment Officer of Coolabah. Take it away.
Yeah, so I started at Goldman Sachs, working for Malcolm Turnbull in London and Sydney. And then I went to the Reserve Bank of Australia as an economist. I studied for a PhD at Cambridge University in the UK. From there, I set up a business, a fixed income funds management business. And it was very quantitatively orientated. And I ended up selling that to Macquarie Bank in 2010, I believe. And I started Coolabah Capital Investments in 2011.
Yeah, okay.
And we launched our first fund in 2012.
2012. Wow, well done. And my understanding is that you guys are the most active trader of bonds in Australia and probably one of the most around the world. Is that right?
So we run about $15.5 billion today.
Yeah.
Across many portfolios. And we have the biggest team in fixed income in Australia. So I have 54 professionals, 12 traders, 21 analysts. We trade about $500 million to $1 billion of bonds every day.
Every day. Yeah, that's the volume that you guys are trading on. Yeah, so that's very active then. Yeah. And my understanding is that you guys also run 4 different ETFs, of which one is the Better Share one. Is that right?
Yeah, actually, I guess technically 5. So we run HBID, which is a bond and hybrid ETF product. Last 12 months, it's returned about 6.1% after fees. The average credit rating is in the A band, so daily liquidity and relatively low return volatility. And we also run the passive version of that product called BHYB for beta shares, which only invests in major bank hybrids. Which we'll probably talk about later.
Yeah,
in terms of what a hybrid is.
Yeah.
And then we run FRNS, which is like a cash enhanced ETF. Current yield is around 5%. And then we also run a fairly novel ETF that's very popular called YLDX, which is leveraged Aussie bank bonds. So really mainly major bank bonds. Actually, it can have and does have some global bank exposures, but mainly CBA, ANZ, NAB, Westpac bonds, and it's currently yielding about 7.1%.
Yeah, amazing.
And that's also daily liquidity. It's A+ rated.
Yep.
It's floating rate, which means you're not taking interest rate risk. The A rating or the A+ rating is a signal that it has extremely low default risk.
Yeah.
Really, you're taking a risk on the major banks paying their debts.
Yes, of course. And so I'm not wrong to say that you're probably one of the experts on the bond market in Australia.
It's what we focus on. And
Yeah.
as you said, we trade more than anyone else.
Yeah,
So,
absolutely. So now we're going to really simplify and dumb it down a little bit.
Sure.
Because I don't think a lot of our listeners understand what a bond actually is. So I think in the simplest term, what is a bond and what does it do?
well, for all the doctors and dentists,
Yeah.
you guys own property.
Yeah.
And when you buy an investment property or a commercial asset, you borrow money from the bank. That's a loan, a mortgage, and you pay the bank interest. Imagine being the bank. That's basically what bond investing is. So we're the lender. We receive the interest and we make a loan. So a bond is just a loan. It's a debt security. The difference between a mortgage and a bond is you can buy and sell the bond. With a mortgage, typically, if you lend money to your friend who's a doctor or a dentist to make a speculative investment or to build a property, it's very hard to get out of that loan. So we lend money, interestingly, to the biggest companies and governments in the world. So typically, the people borrowing off us are the safest borrowers in the world.
Yeah.
So we are, for example, the most active trader of Commonwealth government bonds. We're lending money to Australia, the federal government, which is AAA rated.
Yeah.
It's basically the safest borrower that exists, and they pay us interest.
Yeah.
We also lend money to the 4 major banks. They pay us interest. So when you get a home loan from CBA, some of that money, small percentage, is coming from Coolabah. Because what happens is CBA issues a bond. Now, a bond is actually a loan. So when it issues a bond, it's borrowing money off lenders like Coolabah. And but the beauty of a bond is we can put 100 million into a CBA bond and a few hours later sell it to somebody else.
Yeah. So it's like a mortgage you can sell and buy.
It's a debt.
It's a debt you can.
Yeah,
it's a loan.
that's exactly right. I mean, a mortgage isn't generally tradable. The key demarcation with a bond is there'll normally be many investors who own a share of each bond. So much like if you buy CBA shares, many people own CBA shares.
Yeah.
When CBA does a capital raising, so it issues equity on the ASX, it's raising equity funding. When CBA does an issue of a bond, it's raising debt funding. And what's interesting is CBA's balance sheet, or what we call the capital stack, actually looks very similar to the typical home buyer.
Oh, really?
So a new home buyer would probably have a 10% deposit and a 90% mortgage. So they're 10 times levered.
Yep.
And they pay money to the bank, ANZ. CBA and the other major banks, in what is called risk-weighted terms, this is a fancy piece of jargon, ignore it. But basically, if you use risk-weighted data, CBA's balance sheet is roughly comprised of 10% equity, like a first-time buyer, and 90% debt. So when you get a loan from CBA, 10%, you could think of it this way, it's not exactly right, but 10% is coming from the shareholders, the equity, and 90% is coming from the lenders to CBA. Now, who are the lenders? There's really kind of 2 key classes. People who put money in bank deposits. You don't think of it this way, but when you put money into quote unquote cash, a bank deposit is actually a loan from you to the bank, and the bank pays you interest. So a bank deposit is a debt security, as is a TD, as is a bond. So if you think about CBA, we call its balance sheet, but where does it get its money from? 10% equity, 90% debt. Again, they're rough numbers. And of the debt piece, probably about 70% comes from deposits and 30% from bonds. So if we break it down that way, we can then say to ourselves, well, I can get the cash rate of CBA if I lend via a deposit, and I can't trade a deposit. Once you put money into a 12-month TD, you're stuck.
Yeah.
No one's going to buy the TD off you.
Yeah. When you mean TDs, term deposits.
Yeah, term deposits, yeah. And let's say a typical TD rate probably right now is about 4.25%. So you can lend money to CBA through a term deposit and you get a bit above the RBA cash rate. The RBA cash rate right now is 3.85. Maybe at 4.25, maybe even 4.5. Generally, the bonds pay high rates of interest, partly because the investors in bonds are almost all institutional investors and they're more demanding. We demand higher rates of interest, partly because some of the bonds are actually riskier than deposits. So if you invest in a senior ranking bond, as it's called, issued by CBA, some senior bonds actually rank above deposits. What that means is they are safer than deposits. They're called covered senior bonds or senior secured bonds. So you can actually buy bonds that are safer than deposits. And they might pay interest rates today, rough numbers of about 4.5%. And then there's some other senior bonds called senior unsecured bonds, and they sit behind deposits in the capital structure. And they might pay 4.5% to 5%. And then you can buy another type of bond called a subordinated bond from CBA. And that sits below the senior secured bonds, the senior unsecured bonds, then you got the subordinated bonds. So if CBA were to blow up, the first people to get their money are the senior secured bonds, then the depositors, then the senior unsecured bonds, then the subordinated bondholders get paid out. And then below the subordinated bondholders are the hybrids. So today, again, if the cash rate's 3.85, TDs are paying 4.25. Senior bonds from the same bank are paying maybe 4.5 to 5. Subordinated bonds are probably paying 5 to 6. More like 5 to 5.5, but let's say circa 5.5. And then hybrids are typically paying, which rank one notch below the capital stack, are typically paying 5.5 to 6. Some above 6, and some subordinated bonds are paying 6. So, for example, we bid for $100 million this week of NAB subordinated bonds that were paying about 5.85%, rough numbers. And so investors in the retail market often don't understand that they have this flexibility, they have this choice, because they're stuck in cash land, they're stuck in term deposits or at call accounts. What's amazing is if you think about your transaction account, you know, you got a transaction account with CBA, you're getting zero interest. So you're actually lending money to CBA for free.
Absolutely.
And so the banks love deposits because they are the cheapest way for a bank to borrow money from the world is via a bank deposit, particularly a transaction account, then a savings account, then a term deposit in terms of how much it costs, how much interest the bank has to pay you as a lender to the bank.
As in the cost of the bank, obviously.
Now, there is a government guarantee on deposits, but it caps at $250,000. So above that, you've got no guarantee. You're taking the same risk as a bondholder. Now, what is the risk of a bondholder? Really, the main risk is the bank defaults and the bond doesn't repay it. And that's basically never happened in Australian history. It's extremely rare. And particularly in the case of, obviously, the major banks, has not happened. The CBA, NZ, NAB, and Westpac are four of the safest banks in the world. There are other risks around the market value of bonds, which we can talk about. There are two types of bonds generally, and they are exactly the same as a fixed rate term deposit versus a variable rate savings account. So with a variable rate account, cash account at the bank, if the RBA lifts the cash rate, the variable rate goes up. If the RBA cuts rates, the variable rate goes down. With a TD, once you lock in the rate for 12 months, that's your yield. That's your interest rate. It doesn't change no matter what the RBA does. The banks issued two types of bonds that are almost identical. A fixed rate bond, which is like a fixed rate term deposit, pays a fixed interest rate for the 1 year life of the bond or the 3 year life of the bond or the 5 or 10 year life of the bond. And then a variable rate or what we call a floating rate bond or a floating rate note. The word note is no different to debt security loan bond. It all means debt. So you often hear the term FRN, floating rate notes, and then fixed rate bonds. So typically what CBA will do, or any of the banks will do, they might issue $2 billion, and maybe half is, $1 billion is floating rate notes and $1 billion is fixed rate bonds. But they both pay, say, 6%. And you can choose to take two types of risks. In the floating rate note, at 6%. If the RBA drops the cash rate, the FRN yield will drop with the cash rate. Or if the RBA hikes, it'll rise.
Yep.
With the 6% fixed rate bond from CBA, in that scenario, what the RBA does doesn't matter. It's always going to pay 6%.
It's always going to be the same percentage.
However, imagine this. Imagine there's an inflation shock and the RBA lifts rates massively.
Yeah.
And let's say the cash rate, it's 3.85%. Let's say it goes to 10%. Obviously, that's not going to happen, but imagine it did. Well, if the cash rate's at 10%, then a CBA bond would be paying 11 or 12.
Yeah.
Right? Because the CBA bond is always going to pay you a margin above the cash rate.
Yeah.
In the same way that term deposits will generally pay you a bit of extra interest above the RBA cash rate. The RBA cash rate is known as the risk-free rate. That is the lowest interest rate. It's basically what a riskless borrower would borrow at. And so if you're holding a 6% fixed rate bond from CBA and the cash rate goes to 10,
it's terrible.
And CBA is now offering 12% bonds, is anyone going to buy the 6% yielding 10-year, say, CBA bond at 100 cents in the dollar? No. They're going to say, I'm going to pay you a lot less than 100 cents in the dollar to get up to a 12% yield.
Yeah.
Right? And so that's the risk with a fixed rate bond. With a fixed rate bond, if the cash rate rises, you lose.
Yep.
Generally because yields will rise and you would have locked in at a lower interest rate. So your bond price will fall such that anyone buying the bond off you will get a yield that is equivalent to the market yield.
Yeah.
The other alternative, of course, is that if the RBA cuts rates or yields fall and you've locked in a terrific interest rate. I remember in 2008, you could get term deposits from the banks at 8%. Incredible yields. Now, today you can only get 4.5% or 4.25%. But if I had a CBA TD paying 8%, I could probably sell it for 4.5%. If I really, really wanted to, I could convince someone to take it off my hands. If that was practically possible. And that would mean they'd pay me more than 100 cents in the dollar. So your bond price goes up as yields fall. Your bond price goes down as yields rise if you fix the yield.
Yeah.
In a floating rate note, the price doesn't move around. The yield moves around like a savings account. So all you need to think about is variable rate savings account versus fixed rate term deposit. And then imagine you can buy and sell the savings account or the term deposit. That's the difference between a floating rate note and a fixed rate bond. Another way of thinking about it is imagine you're the bank and you've got a floating rate mortgage, a variable rate mortgage,
yes, or
you've got a fixed rate home loan. Same diff, basically.
So obviously, like a fixed interest, a couple of years ago during COVID, the interest rate was like rock bottom. The banks are going giving out 2% fixed rates, and whoever locked those in for 3 years are just laughing.
I think I locked one in for 1.9. Yeah,
1.9. Oh,
amazing to think of, compared to my 6.8% rate today.
Fixed. Yeah, absolutely. So, I mean, that's the same way you think about the bonds, right? So do the banks then in that situation, when they match their fixed rate home loans with also issuing fixed rate bonds and variable with variable, or is that quite a bit of mismatch?
That's actually a really interesting point. So if you think about the banks, they take in all these deposits and most of that money is variable rate deposits. There are some TDs, but they're a minority. And then most home loans, about 80%, are also variable rate.
Yeah.
So in a perfect world, the banks are funding their home loans like for like. So 80% of the loans would be funded through variable rate savings accounts and floating rate notes or bonds. And the remaining amount will be funded by fixed rate TDs and fixed rate bonds.
Yeah. No, that's like, but obviously it's not perfect. So there's bits and pieces in there, and that's why they offer a margin for those things as well. Based on what you described, if you had a fixed rate bond, obviously if the price goes up, price goes down according to what the prevailing interest rates are. You could actually technically have a capital gain or capital loss event if you bought and sold bonds.
Yeah, you can actually have capital gains or losses on both FRNs and fixed rate bonds.
Okay.
For two different reasons.
Right.
With the fixed rate bonds, the first risk is you've locked in your rate of interest and rates rise.
Yeah.
and you've locked in at a lower rate, so the price of the bond will fall. But there's also that margin, we call it a spread, that the borrower of the bond has set. So remember when we were talking about subordinated bonds, we said that you can buy some, we call it sub-debt, or hybrids are another example, at around 6%. So that is currently a 2.15% margin above the RBA cash rate. So the cash rate is currently 3.85. And so 2.15% gets you to 6%.
Yep.
Now, this is where it gets slightly more nuanced. The all-in yield on a fixed rate bond is 6%. If the RBA cash rate rises, the bond price will fall. But that 6% is made up of two parts. The cash rate, which is 3.85, and the spread that CBA has to pay to get people to buy sub-debt or senior bonds, the 2.15%.
Yeah.
So if the spread widens, you can also lose money. So another way of thinking about this is, let's take senior bonds and use some simple numbers. In recent times, banks have paid a spread of about 1% above the RBA cash rate to raise money via senior bonds. So if the cash rate is 3.85 and a senior bond pays 4.85, happy days. Now let's assume you've bought a floating rate note. That floating rate note, the yield it pays will move up and down with the RBA cash rate. So if the cash rate goes from 3.85 to 4.85 and the FRN is paying a 1% spread above cash, it will now pay 5.85.
Yeah.
Conversely, if the cash rate goes from 3.85 to 2.85, the FRN, which doesn't pay a fixed yield, it will pay a floating yield of 3.85. Now, what happens if the world turns around and says, well, that fixed margin, that 1% above cash,
not good enough anymore.
Not good enough anymore.
Yeah.
We want more. So Aussie banks, rather than paying 1%, we want you to pay 2%. Well, the price of the FRN will fall until you get a 2% margin above cash.
Yes.
In the form of that floating rate yield. And therefore, in fixed rate bonds, you can have the same dynamic.
Yeah.
You can have a capital loss because the RBA cash rate rises,
Yeah.
or because credit spreads widen.
Yeah.
And a credit spread is the margin above cash that the bank has to pay us as bond investors. A way of kind of thinking about this is, if you get a home loan today, you might pay 5.85 for a floating rate loan. And that would be a 2% spread above the RBA cash rate. So you as a borrower are having to pay 2% above cash. But if banks get really nervous, they might say, well, actually, and they have done this in the past, we're going to have an outer cycle hike by lenders. And they might say, for investment properties, we're not offering 5.85 anymore.
Yeah.
It might be 6.85.
Yeah.
So suddenly as a borrower, you're paying a 3% margin above cash.
Yeah, right.
And the same principle applies in bonds. And so what Coolabah is expert at doing is, we have many, many bond pricing models. We have 21 analysts. Most of those guys are quants. So they have backgrounds in stats, engineering, mathematics, physics, etc. And we make it our mission to price the interest rates on bonds as accurately as possible. So we want to know where the cheap bonds are and where the expensive ones are. We want to find that CBA senior bond that's paying a 1% spread that should only pay, say, a 0.5% spread.
Yeah.
Or that ANZ sub-debt that's paying a 2% spread that should really only be paying a 1.5% spread.
Right.
And if we're effective at doing that, what will happen is the spread will compress. So we buy, say, an ANZ subordinated bond paying 6%. And if the spread compresses by 0.5 percentage point or by 50 basis points, the yield will come down from 6% to 5.5%, all else being equal, and we'll make a capital gain.
Yeah.
And this is what we do all day, every day. Now, I've used big numbers. Typically, we earn spread compression of normally only 5 or 10 basis points. It's small.
Yeah.
So it's like the yield going from 6.1 to 6.
Yeah.
And we get a little capital gain. And then when we monetize or capture that capital gain, we sell the bond and we move on, and we continuously turn over the portfolio.
Yeah.
And in that way, it's kind of like buying and selling houses. Because if you have an investment property or a commercial property, you're thinking about your yield. So what are commercial property yields today?
Oh, depending, but like say 5%.
Well, that's actually not that attractive, to be honest. So a 5% commercial property yield, think about all the risk you're taking on that. It could get destroyed by a natural disaster. Yes, you might have insurance in place, but it might fall in value by 20, 30%. Conversely, it could rise in value. With a CBA bond or an ANZ bond, if you hold them to maturity, you're always going to get your $100 back, unless you think, as in your what we call the face value of the bond, the amount that you invest in the bond. So let's say you put $100 million into the bond. Unless ANZ, CBA, NAB, and Westpac go bust, you're always getting that money back. You're always getting your principal back.
Yeah. So you might be getting less interest because the rate's gone up and you haven't sold them for a loss. Just say that instance.
So that's an important point. So let's imagine you bought a fixed rate bond paying 6% from CBA and rates go up. You have an unrealized loss.
Yeah.
But if you hold it to maturity, there's no loss at all.
Yeah, you're still going to get cash back.
Yeah. So the bonds have very, very low risk unless you think CBA, ANZ, NAB, and Westpac are risky. Now, obviously, there can be risky bond issuers. 2 examples. Credit Suisse was paying interest rates on its bonds of about 10% in 2022. And Credit Suisse is a Swiss bank.
Yeah.
And they blew up in March 23. And the hybrid holders lost all their money. Another example would be Virgin Airlines issued popular bonds in Australia, paying 7.75%, superficially attractive interest rate, and they went bust in the pandemic, and those guys lost all their money.
Yeah.
Right?
Yeah.
So we at Coolabah focus on the safest issuers, the safest companies in the world, government bonds, and the safest banks and safest corporates in the world.
Yeah.
Our mission is to find bond issuers that really have no risk.
Yeah.
We don't want to have a default event. And then what we want to focus on is finding the bonds paying a bit of excess interest. And if we can not hold the bond to maturity but sell it as the spread comes in, we get a capital gain. So coming back to the commercial property example, you buy the commercial property because it's paying you 5% yield, first order. We're buying the bond because we're actually getting similar yields. On our portfolio today, we're actually paying with leverage yields of 7 to 8%. So ANZ, NAB, CBA, Westpac bonds, A+ rated. We take the bonds, we leverage them up, and we're getting a levered yield of 7 to 8%. First point. Second point is, if we're really smart in buying and selling the bonds, we can basically target the bonds paying 10 basis points of extra spread or yield.
Yep.
Buy it at 6.1%, sell it at 6%. We get a little capital gain, we move on.
Yep.
The typical capital gain we earn in new bond issues is about 0.5% of capital gain. Doesn't sound like much, but if you continuously do that all the time, that compounds up into massive numbers each year.
Because you were saying that you guys are managing about 15 billion assets under management.
Correct. And
you trade up to 5 billion a day?
No, $500 million.
Oh, so $500 million, sorry, 500 million a day.
Yeah.
Yeah. So, I mean, that's 1/30th of your portfolio.
Correct.
In one day.
Yeah.
And it's, 365. So you're really turning over your entire portfolio 10x a year.
Yeah, we can do that definitely. And in fact, we can turn it over. We have some strategies where we turn it over 20 to 30 times a year. Yeah. We have one strategy, our government bond trading strategy, where we turn it over 100 times a year.
Yeah. And so when you're doing it 100 times a year times 0.1%, that's 10%.
Yeah, exactly.
Yeah.
So, we have had years where our portfolios have returned as much as 10, 15%.
Yeah.
So coming back to the commercial property example, you might get a 5% yield. Now, we have portfolios that are paying 5%. We have portfolios that are paying, let's talk about ETFs. HBRD is paying about 6%.
Yeah.
And then YLDX is paying 7.1%. But in addition to the yield, we're getting that trading gain. We call it alpha or that capital gain. So when you buy the commercial property, you're getting the yield, but you're also hoping to get a capital gain on the asset.
Yes, of course.
If you buy an investment property, you might get on an apartment in Melbourne today 5%. If you're in Sydney, you're only getting 4%. Now that's before stamp duty, land tax, council duties, or your holding costs and transaction costs. So your net yield is probably another 1% below that. So if you're getting a 5% yield on an apartment, net maybe it's 4%, but you're hoping for a bit of capital gain.
Yeah, yeah. And obviously with property, you get a bit more leverage. You get maybe 5x leverage or sometimes 10x at the start, but most people would pay it down at some stage.
Correct.
Yeah, but in the usual bond situation, you're not leveraging, but obviously you have a property that does leverage.
Yes.
So that sort of discounts that leverage issue.
Yeah, so we have strategies. So FRNS and HBRD, they're not leveraged at all, and they're paying 5% yield and 6% yield, but they also get their capital gains.
Yeah, yeah.
So the capital gains can lift the return by another 1, 2, 3%.
Yeah.
We're not getting capital gains typically of like 10, 20, 30% per annum, like you might get, in an unbelievable year on a house, for example, in Bellevue Hill. But we are getting some capital gains that are from the trading returns that further supplement or augment the yield. In our levered strategies like Wild DX, we're getting a 7.1% yield. And in very good years, we've had total returns north of 10% because of another few percentage points of trading alpha.
I mean, but obviously the difference is that when you're trading these assets, it's very liquid. It's daily liquidity almost.
Hell yeah. So the bond market is massive, trillions of dollars. In fact, globally, the bond market, the bank bond market and corporate bond market is $30 trillion in size, Aussie. And then if you include the government bond market, that's another $80 trillion. So it's super liquid. As you mentioned, we trade $500 million to $1 billion a day. And that makes it very different to property.
Yeah.
With a commercial property, it can take years to sell. Even with a residential property, it can take a year or two to sell if it's an expensive home or if it's in a idiosyncratic market. So with property, you've got huge transaction costs. And think about what we call the bid offer spread. The difference between the buy price and the vendor ask in property is massive. Like you might have a home, just to pull big numbers out of the sky, but you might have a home that the vendor thinks worth 10 million and the bidder thinks is worth 8 million, right? That's a huge difference between the buy price and the ask. In the bond market, that difference is like trivially small. So, the transaction cost in the bond market might be 0.05 to 0.1% max, right? That would be a high transaction cost.
Yeah, I mean the price transparency is there, whereas with properties, it's just like, it's whoever wants to pay what.
It's also because it's not so much actually, it is an interesting point about price transparency. The bond market is actually very opaque because we don't trade bonds on an exchange. We trade them what we call in the unlisted market. So it's actually very similar to the housing market. So in the housing market, if you buy a house, nobody sees the price typically for about 3 months. Once you pay stamp duty, the land titles office will disclose the price on a house. When we trade bonds, the price is actually never disclosed and it's not transparent. So it's a very, very dark market. That's why it's inefficient. That's why we can find all these pricing discrepancies. Different to shares. If you trade the equity market on the ASX, you trade $1 billion of CBA shares. Everyone in the world sees the price. They see the trades. You trade $1 billion of CBA bonds, which we do. Nobody sees the price of the volume. So,
let me rephrase that. It's not price transparency. It is you can have very similar
standardization.
Standard.
Yes, I was going to come to
Sorry.
it. So the key reason there's a huge bid offer spread in housing or property is because it's idiosyncratic. My Bellevue Hill house is different to everyone else's Bellevue Hill house, right? And so the price of my house is also very different. Whereas a CBA bond is the same as every other CBA bond. So these assets, bonds are super, super safe and super liquid and super standardized. And therefore they're highly, highly tradable. Now, you can't generalize. Of course, there are some bonds.
It's junk bonds.
Exactly. You took the words out of my mouth. There are bonds that are awfully risky, like Virgin bonds or Credit Suisse hybrids. And there have been other kind of shonky little companies in Australia that have issued bonds and people have gobbled them up and they've actually turned out to be disasters. But that's not what we do. We only trade the safest, most liquid bonds on the planet because we need that liquidity. Because we want to trade, you need to always be able to have a bid and an offer. And the key driver of liquidity in financial markets is safety. The riskier an asset, the less liquid it will be. The safer an asset, the more liquid it will be. And that's also true generally in property. If there's a commercial building that every super fund in Australia wants to buy, then obviously there's going to be a liquidity, and if that's really safe and attractive to those investors. Conversely, if there's a commercial asset that not many people want to buy, it's going to be really, really hard to trade it.
Yeah, of course. So it sounds like bonds is this sort of underappreciated asset by the typical retail investor.
I think Retail investors and self-managed super generally have cash, equities, and property.
Which is really puzzling for me because, bonds are very liquid, relatively safe if you get the safer ones, and they yield better than cash. So
and actually they yield better than property.
Yeah. I mean, on a unleveraged,
even unleveraged,
basis,
the hybrids are paying 6% yields,
Yeah.
which is better than resi and better than a lot of the commercial stuff. Even though the hybrids are ostensibly safer than residential property or commercial.
And with the liquidity, right? Because
with the liquidity,
Yeah,
and,
exactly.
People forget that liquidity is really, really valuable. If you have a life event, you suddenly need to liquidate those assets. Well, selling a house is hard. Selling a commercial asset is really, really hard. But selling a bond is easy. Now, what has started to change is the advent of ETFs, so exchange traded funds. And we have seen a proliferation of bond ETFs.
Yes.
And so I think many of the viewers of this podcast might start obtaining exposure to bonds through popular ETFs like our WildEX or HBRD or FRNS. And there are many other providers out there who are supplying exposures to different parts of the bond market via ETFs. So ETFs have really revolutionized, I think, the capacity to diversify. But I would say as a generalization, most people are very long cash, equities, and property. And the funny thing about that is it's kind of a barbell. Equities are super risky. Property is very risky. Cash has got no risk. And there's nothing in between. And that's really the job of bonds in a portfolio, is to provide a bridge between your cash and your equity and property risk.
And obviously, if you're buying a bond ETF, you got to look like what sort of bonds they're actually trading in, or are they how long they're holding them. And
so this is a great point. So what people don't understand is like ETFs have become immensely popular, and I think they're fantastic. And most ETFs are passive, and what that means is they just track an index. They are not focused on value. They are not looking for the cheap bonds. They are not trying to avoid the expensive bonds. They're just going to follow whatever bond index they are based on.
Yes.
And that's okay if you want general exposure to bonds. There's definitely a role for passive, bond portfolios. But, there's also a role, and I think a very persuasive role, for active bond management, because the bond market is opaque. It is super inefficient. We make money statistically around 80% of the time we trade in the bond market. So our win ratios are very high because of the inherent inefficiency of the market. It's actually much harder to make money in efficient markets like equities.
Yes.
In equities, your win ratios are going to be more like 50, 55, maybe 60% if you're unbelievably good.
Yeah.
Because everyone in the world is competing in equities, and crucially, it's transparent. So stocks are listed on exchanges. When you trade, you're competing against algorithms. You're competing against the quant shops. You're competing against everyone in the world who can see your price and volume of trade. In the bond market, there's no price reporting, there's no volume reporting, and there's very few algorithms. So you're not competing against the quants. You're just competing against banks, central banks.
Or even the front runners.
The pension funds. And it's super inefficient. So you get a lot of pricing discrepancies. So the role for active management is much actually interestingly greater in bonds than in stocks.
Interesting.
Because the market is inefficiently priced. So it's a bit of a paradox. On the one hand, it's a wholesale or insto market. It's very hard to participate if you're a retail punter in bonds because the minimum parcel size, the minimum ticket size in the unlisted bond market is normally $500,000, right? So you can't buy a $100 bond like you can buy a $100 stock.
Yeah.
What the ETFs do is they collapse that, and they've brought bonds onto the exchanges in the form of funds, and you can buy a $100 ETF. The challenge with ETFs, if they're not active, is the passive nature where you're not getting the trading gains, the trading alpha. And that's what Coolabah is really the
monetize the alpha.
Yeah.
Well, that's a fascinating sort of primer on bonds. I guess I think the last thing which we haven't talked about is what determines the risk of the bond and how the credit agencies come into sort of this role. Because you mentioned A bonds, AAA bonds. I'm sure if there's an A, there's probably B, and there's probably more letters C.
Yeah.
What's the top one is AAA, I guess.
what ratings signify is the risk of default, the risk that the bond issuer doesn't pay the interest on the bond. And there are broad, what we call rating bands, the C band, the B band, the A band. And, specifically we trade what are called investment grade bonds. And investment grade bonds are more highly rated bonds that have lower default risks. And in my world, I trade triple B rated bonds. And then within that triple B band, there's triple B minus, triple B flat, triple B plus. And then we move into the A band, and they're safer bonds that have lower default risks.
Yes.
So you have A minus, A plus. Then you move into the double A band, and you have double A minus, double A plus, and then finally you go into the triple A band. And there's very few triple A rated bond issuers in the world. Australia, as its government, when the government borrows money, is one of the few triple A rated issuers. A state like Queensland is only rated double A plus, so it's not triple A. Very safe at double A plus. But let's talk about risks though, more broadly.
Yes.
So the first risk with bonds is the risk of default. By focusing on investment grade bonds, they're the highest rated bonds, rated triple B through to triple A. You're really minimizing the risk of default. It can happen, but it's a very, very low risk. And particularly in the portfolios we build, we are absolutely maniacally focused on minimizing default risk. We don't have any default risk. We don't have a Virgin Airlines or a Credit Suisse. So that's one risk, and which you can immunize by focusing on highly rated bonds. A second risk is liquidity risk. Now, liquidity risk is you're stuck with a bond, no one will let you trade it, and you have to hold it to maturity, and you have to wait to get repaid at the end of the period. An extreme form of liquidity is what is known as private credit. Private credit is when you might lend to a developer, a property developer.
So we've seen quite a few of those.
What's that?
I've seen quite a few of those around.
So it's been a very popular industry, and there are great private credit managers out there, and obviously not so great managers, but those guys specialize in loans that are not tradable. You can't buy and sell them. You make the loan to the developer and hopefully you do well, but obviously the risk is you don't do well and you're stuck with it. In the bond world, we again try and focus on only liquid bonds. The liquidity is really driven by risk. The lower the default risk, the more tradable the bond is. So by only focusing on the highest rated bonds, you really minimize both default risk and liquidity risk. And the final risk in bonds is market value risk. And that is what we talked about earlier. Just changes in credit spreads and changes in the RBA cash rate. But they also present opportunities. If you can, like we do, find bonds paying too much spread, or put differently, too high a yield, you can actually make capital gains from that as the yield normalizes. And there are people out there that also try and bet on the direction of the RBA cash rate. So there might be traders who think the RBA will lift rates or cut rates, and they would allege that they can make money doing that. We think that's actually very hard because you do that through a listed market called the interest rate futures market, and that's listed on the ASX. It's a different part of the fixed income world. We've only been talking on this episode about physical bonds. CBA, NZ, NAB, Westpac bonds, the actual bonds themselves. You can bet on what the RBA is going to do through something called a derivative, particularly a futures contract, and you can do that on the ASX. And that market is listed, it's liquid and transparent, and it's very algorithmic and very quantitative. And it's very, very hard to get edge in that market because it's hyper efficient. The inefficient market is the physical opaque bond market. It's the same as housing.
Oh, what is that market in Australia called? Or is that like is there not say an exchange? What does that look like? No, it's
by definition not on an exchange. So an exchange is a centralized trading domain. The bond market is decentralized. It's literally like, where
it's like a trading desk or
so we Coolabah trade with 80 counterparties around the world.
Right. Okay.
And they're mainly banks. So we're pretty much trading with every bank in the world. But every time we trade bilaterally. We don't trade on an exchange. There are centralized, this is slightly more complicated, but when you come to trade a bond, it typically settles. That is, the cash changes hands within a couple of days. And when the bond settles, it settles via a clearinghouse, and that clearinghouse is centralized. So in Australia, it's called Austraclear, and it's owned by the ASX. So the settlement is centralized through the ASX.
But the trade isn't.
But the trade is bilateral. So it's literally like, I'm buying a bond off my grandmother and selling it to my cousin.
And that's where the opacity and
correct.
The inefficiencies lie, because
correct.
You can just negotiate on certain things.
It's a very negotiated market. And again, very similar to opaque parts of the property market.
Yeah.
If you're really expert in your suburb, you know all about the prices, you know what the cheap deals are, what the expensive homes are, you can use that edge or that competitive advantage to make quite a lot of money if you're an expert on your local property market. And the same is true of the unlisted bond market.
Yeah, because you're the experts on the bond market.
Correct.
Very interesting. So thank you for that primer on bonds, and I'm sure we'll have more to discuss in future episodes. Thank you for joining us, Chris.
Thank you very much.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.